Warren Buffett is one of the greatest investors of all time. Buffett took control of Berkshire Hathaway in 1965 and ran it like a mutual fund, buying all sorts of businesses including insurance companies, railroads, chocolatiers, and many, many others. $1,000 invested into Berkshire in 1965 would have turned into nearly $50 million today. By comparison, investing the $1,000 into a US stocks index fund would have turned into nearly $300,000 over the same period. In other words, you would have been over 100 times richer trusting your money with Warren Buffett than by buying index funds. So, how did Buffett do it? Surprisingly, he made no secret about how he chose stocks. But as we'll see, knowing the how does not mean we can invest as well as he can. With that in mind, let's dive into the how. Buffett's core idea is to buy stocks for less than their worth. This approach is called value investing. Sounds simple enough, but how do you decide what a company is worth? Investors use different methods of valuing companies, and perhaps the most common method is to compare financial ratios such as the price-to-earnings ratio or the price-to-sales ratio between the different companies. Many value investors and most systematic value investing strategies rely on these ratios, but this is not how Warren Buffett values stocks. Instead, Buffett tries to estimate something called intrinsic value of each stock, which he defines as the discounted value of the cash that can be taken out of a business during its remaining life. Let me explain what this means. If you buy a stock of a company, and if that company generates profits, it will eventually reward you. Some companies will pay out dividends, while other companies will make intellectual property that's so valuable that they become takeover targets. Biotech companies generally follow this route. To estimate intrinsic value, investors need to project the cash that they think they'll receive, and then they need to discount the future cash, which means shrinking their size for having to wait to receive them. For example, we could say $10 in 3 years is only worth $8 today. Cash investors receive soon should be discounted only slightly, while cash that's expected to arrive after many years should be discounted by a lot because they're waiting that much longer to receive them. The sum of these discounted cash flows is the intrinsic value. In other words, intrinsic value is a stock's value if you never plan on selling it. So if you want to invest like Warren Buffett, you should estimate each company's intrinsic value and compare it against the stock's price. If the price is much lower, buy it and hold on to it until the price exceeds the intrinsic value. And if you're right about the intrinsic value, you will eventually be rewarded. Sounds simple, doesn't it? Trust me, it's not. The problem is that estimating intrinsic values is really hard. A typical company derives most of its value based on how it'll do in the far future, like in 10, 20, or 30 years. Think about how much the world has changed in 30 years. Google didn't exist, and people listened to music on CDs. Cameras used to need film to take pictures. Many companies that looked like they'd be around forever got disrupted and disappeared. I mean, for the young viewers out there, do you even know what Kodak did? Of course, on the flip side, companies like Apple did spectacularly better than most investors expected. So how does an investor foresee these changes in fortunes? Some investors go on the offensive. They study technology to imagine which of the young companies today will grow into the next Apples and Amazons of tomorrow. Many such companies won't fulfill that potential and lose money, but they're betting that the ones that do will more than make up for them. ARK founder Cathie Wood is an example of such an investor, and venture capitalists in general follow this philosophy as well. Warren Buffett, however, is much more of a defensive investor. He'll typically look at companies that are already making good money and ask which ones will continue to make money 30 years from now. His goal is to avoid losing money on any of his investments, which he summed up by saying that the first rule of an investment is don't lose money, and the second rule of an investment is don't forget the first rule. As a result, he'll often go for boring industries that don't face change, such as brick, carpet, insulation, and paint. But that doesn't mean he'll buy any boring company. What he looks for instead is a moat around the company. Moats are advantages that prevent competitors from taking away their profits. One example of a moat is low cost. For example, Buffett bought railroad company BNSF because rail is the cheapest way to move goods on land. And there's no way that another company would build rail where BNSFs already are, because doing so would just be too expensive. Another type of moat makes use of brands and customer habits. Apple is an infamous example of a company that does this. For example, iCloud, which backs up data for the user, only works for Apple's devices. So if you get used to using iCloud, you're not going to want to switch to a non-Apple device. Critics say that Apple goes too far and have threatened legal actions against some of their practices, but the fact that they're willing to go that far should tell you how strong Apple's moat is. So it's no coincidence that Apple is Berkshire Hathaway's largest stock holding. Another quality that Buffett looks for in companies is good management. Specifically, Buffett says that he looks for three things: integrity, intelligence, and energy. But he places special emphasis on integrity, saying that if you don't have that, the other two will kill you. For that reason, I can't ever see Buffett investing in Tesla. When a company has a strong moat and good management, it has a higher chance of remaining profitable for the next 30 years. That allows Buffett to estimate a company's intrinsic value with some confidence, and then if he feels the price is attractive, he'll buy the stock. Now you might be thinking, that doesn't sound too complicated, so why don't other people copy Buffett? In fact, Jeff Bezos once asked Buffett, "Your investment thesis is so simple. Why doesn't everyone copy you?" And Buffett replied, "Because nobody wants to get rich slow." What Buffett meant is that others don't analyze companies with a long enough time horizon. In other words, other investors don't take intrinsic value calculations seriously. But while I think he raises a good point, I felt that he was being a little disingenuous, because his answer assumed that other people could estimate intrinsic values well if they wanted to. But I just don't think that's true. Understanding a company's moat is hard. Someone once asked Charlie Munger, who was Buffett's longtime business partner, on how to identify moats. Munger said, "You basically want me to explain you the difficult subject of identifying moats." It reminds me of a story. One man came to Mozart and asked him how to write a symphony. Mozart replied, "You are too young to write a symphony." The man said, "You were writing symphonies when you were 10 years of age and I'm 21. Mozart said, "Yes, but I didn't run around asking people how to do it." In other words, there is no formula for identifying moats, nor is it easy. It's an art that takes talent and practice. To give you an idea of what identifying a moat requires, Ted Weschler, who works for Buffett, says he spends a minimum of 500 hours researching a single stock before he invests in it. Few people have the discipline to do such deep research and the intellectual capacity to process all that info. I can almost guarantee you that most of the funds that claim to follow value investing are not doing it the way that Buffett does it. Now, does this mean that value investing in general is out of reach for the rest of us? Thankfully, I don't think that's the case. Remember that to follow value investing, we just need to accurately estimate a company's intrinsic value. Warren Buffett has one way of doing that, but his is not the only way. I've already mentioned one other way, which is to discern which young companies will grow into giants, but there are still other ways as well. For example, I use a more data-driven method to finding intrinsic values. I look at how profitable a company is today and use machine learning to forecast how those profits will grow in the future. I then use these forecasts to calculate the intrinsic values of each stock. I'm not going to say that my approach is better than Buffett's approach because there are pros and cons to any approach, but I believe that my approach works. But regardless of the approach, all value investing philosophies suffer from the same weakness. Namely, it can underperform in the short to medium term. For instance, Berkshire Hathaway underperformed the S&P 500 over the length of the 2010s. 10 years is not such a short time. Investors will be forgiven for asking if Buffett has lost his touch. But those people, in my opinion, are wrong. Stock prices are not, for the most part, driven by careful studies of intrinsic values, but by irrational human emotions. And this irrationality can persist for many years. Eventually, though, the stock market does correct itself, which is why Buffett said that in the short term, the market is a popularity contest. In the long term, it is a weighing machine. So the final ingredient that allowed Buffett to succeed is that he was able to stick to his philosophy, even when results were not going his way for years, and there was pressure for him to change. But please remember, your conviction to stick with your investments will only be rewarded if you are correct about their intrinsic values. And if you are right, you will be rewarded eventually, and the rewards can be huge. I hope this video has helped you understand how Warren Buffett invests. Although the ideas are simple, as Charlie Munger says, it's not supposed to be easy. Anyone who finds it easy is stupid. Thanks for watching and see you next time.